Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, October 23rd, 2024. It's 12:09 p.m. Eastern Time, so I'm starting the video. What I'm going to do in this one is stick just to the equity markets so we don't go too long. I usually just brush on the equity markets towards the beginning of some of the videos, hit a couple charts, but today, for the first time in quite some time, like I said, as long as I can remember, got an official trade out to you on the S&P 500. If you recall, the last time the market had a big correction, I was very clear and adamant that we would short QQQ, that had a much better downside potential, and back then we vastly outperformed the S&P 500 on the downside. The S&P only fell about 10%, and we had about a 16% drop in QQQ, and so that my preference was to not short SPY, nor has it been since, because of just the better technical posture, the makeup of the sectors and all that. So this time around, it's still not my preferred index. I still maintain you typically get, and I think you will, more bang for your buck shorting the more volatile Nasdaq 100. The S&P, I call it grandma's index. It's got your steady Eddie dividend paying utilities and defensive issues and healthcare and financials, things that you don't see in the Nasdaq 100. That tends to be more growth oriented, much higher allocation concentration in tech. And so, but again, people have asked me for updates and trade ideas. Some people do like to trade this, and it doesn't really matter if if you think of it this way. When the stars and the moons align, or everything aligns for a trade, I should say, like the S&P. The amount of profit you make on it dollar wise isn't really tied into the percentage up or down. As far as something that has a lower volatility or lower, volatility up and down potential in percentage term, take treasury bonds, you tend to put more money into it. And so, for example, if you're looking for that, let's say that 10% drop in SPY, you could have leveraged up. But the thing is, I usually suggest about a 0.8 beta adjustment, 0.8, 0.9 for the Nasdaq 100, meaning you do about 10-20% less in the position size than you would in the S&P 500. So the point is, you can, because the S&P 500 is going to go up or down less typically, you put more money into it. And now, still, with that being said, that last drop around back in July, even if you beta adjusted up, you still would have outperformed shorting in the Nasdaq 100. This time around, I think we'll see less of a disparity because big tech has kind of already peaked. It's plenty of downside left. I mean, especially if you factor in NVIDIA and things like that. Either way, just remember this. It's a very, very much an overlap trade if you're going to short both QQQ and SPY. Again, they're going to move mostly in the same direction, especially the bigger trends. Just normally, SPY will fall less. Now, there are some exceptions. Financial crisis. If you look at the bear market from October of 2007 into the 2009 lows, you had they went down neck to neck. And that was because these financials were, which pretty much the Nasdaq 100 is lacking. Financials, that sector has virtually zero representation in the Nasdaq 100. And during the financial crisis, it was the big banks that were one of the worst performing, or the bank sector as a whole, worst performing sectors. So you made about, if you shorted the highs and the lows, or measure that bear market move, they both dropped a little north of 55%. But so you got to factor in. The reason I'm going there is you need to factor in, and that's what we're going to do here. I'm going to go over the indexes. We'll look at the ETFs. I'll cover the small caps briefly, and then I'm going to hit the futures for you futures traders. And even if you're not a futures trader, I think you should monitor those charts, even if you prefer ETFs, because there's some key levels there that you might miss that trigger, support and resistance levels that you need to be aware of. And then I'll roll into the sectors of the S&P 500. There's only 11 of them. And as I often say, an index is simply a sum of its parts, or more so a weighted sum of its parts. And so when I go into the indexes, the sectors, I talk on which ones have the biggest weightings and are likely to impact the index more, and which ones have a lower weighting. All right, so there's not much to add on this. I got the trade out to you today. Take it, leave it, up to you. The stop was, based on if you're targeting T4, I give you a max stop in here somewhere shy of that 600 level, give you an attractive RR. That should take us down to the 200-day moving averages right there. You can see the red and the blue line, T4. That's where I was calling the market down to here. We got it. We had the Nasdaq, a lot of other key stocks. And I believe even in the morning there, we had the S&P right on it as well. So but when you look at the daily chart that shows just the regular session trades, it reversed a little shy of it. So I think to call it down there again, even if you are long-term bullish, I think this is still a reasonable swing trade target there. And that's going to give you, from where we're at now, about an 8% drop. So maybe a little north of 9% from the high. So again, that's it. Pretty clear breakdown. Could we get a stick save? Sure. Do I think so? No, or I wouldn't have posted the trade idea. So again, up to you whether you take it, don't take it. And then give you a link to, especially for those new to the site, all the way back in late June, before we got into these market top ranges. I gave you the market top ranges, and that's it. So the S&P is right at the top, and just before the Fed meeting back in a couple months ago, said if they did cut 50, because it was a matter of whether they were going to do 50 or 25, I said 50 would probably take SPY up to the top half of the range, closer up in there, which it did, and that's where we're at, the top of my market top range. So this is a call that dates back to late June, and unless we clearly move above there, and also in QQQ, then that's what I maintain. And nothing that I've seen has convinced me to alter or abandon that view. In fact, it's just, I'm still as much as I felt confident back then that would be where the market peaked before it even did so. That's still where I think it peaks, and we're in that range. So that's it. And it either plays out or it doesn't. And I always say this, that the indexes, although people talk about them every day, you go to a cocktail party, people aren't talking about wheat and natural gas, and they might talk about Bitcoin, some things like that are more mainstream. But everybody wants to talk about the stock market. But remember, if you are a trader, there are traders that only trade the market, but I am big fan of diversification, asset allocation, spreading your bets. And so, this trade either pans out or it doesn't, like any other one. And so right now it's a swing trade, but if you are a longer term trader, those targets I laid out, remember, we covered and reversed the morning of August 5th. So it's really kind of a reset on that and kind of a new entry, at least in my opinion. And that's what I stated that morning. Cover all shorts and go hard long, full long position. And that's the counter trend tradable bounce. And this is where I think we're going. But we'll know soon. Probably know within the next couple of weeks, with the elections coming up, whether the market likes what happens there or doesn't like. And again, more so it's the technicals. That's it. I could sit here and talk all day long about what may happen in the elections, what might not. Let me give you, there's the QQQ. Those are, again, the long-term swing targets, and you have them for SPY as well. Let's just jog down to a 60-minute chart here on QQQ. The levels that I think will probably do the trick, it's right about here. You have 488.27, which is the bottom of my market top range, and it wasn't a random level back then when I first posted it. It's based on technical analysis. It was a resistance level. Currently becomes now a support level, because look, you've had all these reactions. I'm circling. There was a reaction, got rejected, breakout to new all-time highs. That breakout failed. It failed pretty aggressively with a gap down and a big drop that followed. Again, that's at 16 or whatever it was % drop we gained. Rallied back up, got rejected, rallied back up, another rejection. Tried to get in there one day, rejected. Again, this is a 60-minute chart. Up in there now. So now we've recovered that, basically this resistance level, and so was resistance, now support. So again, a break under, we'll call it, rounded down, 488, plus you have this uptrend line coming in here off the August 5th lows. So a break below there in one fell swoop will take out two pretty decent support levels and should get the party started for the Nasdaq 100. Let's cover the smallies. Small caps, watch this trend line here. Again, most indexes and a lot of stocks have uptrend lines off the August 5th lows. It was a major pivot point in the markets. And so on small caps, you can add that line there. I might pull this one down a little bit right there just to be safe and come in. You've got that reaction low there. You've got a reaction right there. A couple of them actually there. And so that should do the trick. And small caps, when you look at from a longer term perspective, remember they still peaked back, put in a big divergent high, big false failed breakout to new highs above this trading range. And they peaked back in 2021 and remain below that. And just like back then, you have this, any pretty much we have about an equal high, and that's still just a divergent high here on the weekly. So what you had here, this was a divergent low. It's not marked as, it's labeled as such, and you can see I have a white line right here just under it. You have to go in real tight. That was an ever so slightly marginal new and divergent low, give you that positive divergence. I have different boards, that's why. See, you can see it's marked up on this board, divergent low, divergent high. It's wash, rinse, repeat stuff. These are the big trends. Most people can't see the forest through the trees. This is the forest. When I look at the weekly charts and the monthly charts, divergent high, big drop, divergent high, even bigger drop. Those were equal highs right there. You can see the divergence continued. COVID hit, nuclear option from the federal government and the Fed and all central banks around the world. You gave up that, but ended with that divergent high there. So far that is the end of the bull market, and then, well, it was followed by a bear market. Can't argue it. That ended with this divergent low, and there it is again, divergent high right there. So I gave you the kind of the near term levels to watch. Take a you can see it better on the daily chart, that uptrend line off the August 5th lows, and on the 60-minute chart you can see too. You can swing trade pretty much any security, but some work better than others. This is my 60-minute chart of IWM, divergent high. Let's just do this. Divergent high, correction, divergent low, rally, divergent high, correction, divergent high, correction. There was a divergent low. They're not all labeled, but guys, you can see it there. Divergent high, low, divergent high, divergent low, divergent high, divergent low, divergent high. But again, this divergent high carries through on the daily and weekly charts. Kind of like what I showed you on GDX and gold and that today, where in an uptrend you can make a fortune even if you don't go long. I mean, all the better if you can go long on the divergent lows. But just shorting, divergent highs in an uptrend on a security that's conducive to it, that has a pattern of, giving you the corrections after the divergent highs once you get the sell signals, that in itself is a profitable trading strategy. But remember that, sooner or later, these smaller divergences, especially when they become cumulative on the more significant daily and weekly charts, I'm just marking up here, then they lead to an even bigger drop. So there's your update on IWM as well. We know what's happened since the Fed cut rates, 50 basis points, long-term and intermediate-term rates as well. That's important. 5-year treasuries, 10 years. They went nowhere but up. The exact opposite direction, not a little bit, a lot. And that is net bearish fundamentally, and I don't think it's been fully priced in. The small caps are the most dependent on lending, borrowing, that is, issuing debt, bonds to finance their operations, much more so than large caps. And they've been, this rally has been predicated on we'd get cuts from the Fed and it would give them some relief. But so far, that's not, they can't borrow from the discount window. They can't, what the banks can. They can't borrow at the federal funds rate. That's for banks to borrow overnight, from each other or from the Fed, the federal funds rate and the discount window. So they need to sell debt. They need to sell it in the open market, and they're subject to whatever the rates are in that range. And again, small caps, the average range is about 5 years maturity on their debt when they issue bonds. Large caps closer to 8 years or so. And so here you can just look at the FVX, it's the yield on the 5-year. And so you can say that, a lot of folks figured rates would be coming down here by now, especially with the Fed rate cut. And you can see what happened. There's my purple line right there. That was the September 18th 50 basis point rate cut. Instead of interest rates going down on the 5-year bond, it went in opposite direction. And the $1 million question is, does that continue? If it does, I can tell you emphatically that's a net negative for the market and especially the small caps. So, and it was priced in too. It's not random. We went long, sorry, we shorted treasuries right then, and we profited, and we used the 30-year because we got more bang for our buck. So, all right, I'm digressing, but it's all related, really. So, I'm talking about the fundamental aspect of interest rates on the market and how that might support a short on both the small caps or the large caps. Okay, next up, we covered SPY in detail. That was pretty simple. Let's cover the futures. Okay, this is ES. These are the S&P 500 index futures. If you're a futures trader, you know that. That actually I'll have to do. Remember back here a few weeks back, we started to diverge. I put these lines orange back here because I projected that if we went higher, that it would only be the divergences, at least for the foreseeable future, would increase. That they weren't at risk of being taken out, and that's why I had the color coded those divergence lines orange back here. And that's what happened. So we went up, market made a marginal new high, gave it that kind of bulletproof feel to those that want to believe the market can only go up, and so that most likely sucked in some more cash. On the long side, as I've talked about recently in recent videos, my volume indicator has hit extremes not seen pretty much in years, if ever. And if you missed that, I'll just toggle over to it. This is it right here on SPY. This is it's the 10-day exponential moving average that I put on the volume indicator. This is the extreme level. This is a level we hit right before the last bear market or the big drop in from 2022 down, beginning of 2022 down into the October 2022 lows. We had the initial and then the subsequent tag. And as I mentioned the other day, we have not seen that level drop until right here before that shot across the bow, just like we had a shot across the bow right here on the first tag of the extreme low right there around 50 million on the 10-day moving average. Got the initial shot across the bow. Market had one little last gasp, a little hurrah, hit it again, and that marked the top of the market there. And so that's what happened here. We had that one little hurrah. The drop, the correction, which we shorted via QQQ. And of course other things, and then one little push up, and now we've hit extremes that again I can roll back as far as I can roll on this daily chart, and I haven't seen the volume drop to this level, and that is a glaring red flag for those of you that incorporate volume into your analysis, especially if you're bullish buying breakout to new highs on the S&P 500 based on the volume pattern, not to mention the divergences and everything else. Alrighty, let's go back to the ES simple stuff. There's our uptrend line, same one I showed you on SPY for shorting SPY today. There's the breakdown. I'm going to zoom in a little tighter. You don't have to squint to see it. And we also had some minor support there. It's taken out. You can see the levels here. First support level, and or target if you're an ES trader. Third. And I haven't updated these in a while, but that kind of gives you an idea right there. And you can also correlate the targets on that SPY chart I gave you. This is, I think, a very likely near-term swing target. That's going to represent a drop in the S&P 500 of about 8%, if we get there. Yeah, right about 8%. All right, let's go on to NQ, my preferred trading proxy. I'll get to that in a second. That's my daily chart. This is the 60-minute chart. We were just looking at the 60 on SPY. I colored this level up for you today, 20,283. That's the level that I think will do the trick. Get some selling going in. We've been consolidating here in this range. And I think a break below that should take us down. This is your first target zone. Really, I'm favoring the bottom of that level there, but it's a zone, a support zone. Runs from about 19,828 up to about 19,918.50 or so. And then 19,572, 19,384, 19,043. and then 18,570. If you recall, and I haven't deviated off this, I just haven't talked about it much because we've just been moving sideways, so my analysis has gone cut back on a little bit. But I suspect that this is the magic number that if and when taken out, and I do expect it to be taken out, but then we'll start to waterfall down. All eyes are going to be on that August 5th pivot low, but I think if we even get near it, market will be in freak out mode and we'll probably blast on through it, and then that brings in the impulsive selling. So the big drop that I've been looking for since late June is still, we're, like I said, we never exceeded my market top. We're in them. We're back exactly where, figure the market would peak, and we had one correction and put us back up in there. The Nasdaq 100 has not made higher highs, and that should be a red flag. It is for me, or more of a green light for shorting. We still had that on the Nasdaq 100. The big bearish engulfing candle put it back there in the beginning of July. And then that was our drop to the 200s. We covered that morning right there. In fact, let's look at the daily chart now. I gave you this. Here, I'll pull them up for you. I got them over here somewhere. All right. Again, this is either a refresher for those of you that have been on the site for a while, or new subscribers. Shortly after those market top, the long-term targets in the market top ranges, calling for where the market would peak. Back in June 26th. A little bit after that, it was July 10th. I followed up for futures traders with some long-term targets. My preference is trading futures for many reasons, including but not limited to the tremendous tax benefits, to the fact they trade around the clock. Liquidity at 3 in the morning. I can go to bed with a stop loss order. I don't have to worry about it, waking up to a big gap against my position if I'm trading, ETFs. But so gave you this NQ 2100-ish, comparable to my QQQ ideal market top range, because the ideal would be if we got closer to the top, it lines up with the Fibonacci retracements. And so, I had used at the time Fibonacci projections to say, point I thought we were going to go higher back in June, a little bit higher, not much. And then we did. And so that was back on September. And remember, the futures have rolled. So if you're going to screenshot this, remember these numbers the levels have changed when the futures roll. But so anyways, that was July 10th. Market peaked, I think, a day or two later, went up there. And let me grab the other one. Let me move this one away. Got this one here. And then the morning of August 5th, I always timestamp all my charts so you can see where we're at. August 5th, we hit, and again, I got that out to you earlier that morning. I took a screenshot of this right before they opened, but before that I stated in pre-market, we were right down there. We had just hit my 6th target. It was a very good target. And that was it. NQ, Nasdaq 100 hit T6 within literally 1 point of my price target, which is, a mere fraction of 1%. Hard reversal, went long. Gave you at the time kind of just some guesstimate targets for the bounce. That would be, and that's what we did. So that was back then. And remember, this was the market top range. My preferred market top range was 2100-ish. We hit a high of 20,983.75. So you're not going to see these calls on CNBC. That was pretty much milking the scope of the bulk of that, almost every penny of that move there. Now here we've come. Let's talk about now, because all that matters. You're only as good as your next trade, I like to say. So we've now come full circle. That was that bounce right off T6. This is the counter trend bounce. And T1, remember, T1 was the first target. This is the live chart. This is where we're at today. And all my, price targets are typically aligned with their support levels on short trades. Support, once broken, becomes resistance, and that's what we rallied back to. It's been a strong rally. It's taken us back to resistance, and so that should be, as long as this top holds, we can do this, and still right. If we do much more than that, then I'm wrong. And maybe these targets get hit later, and we get back in, and it's a whole new trade. But as of now, I'm just talking about now, and I think it's we're ripe for the next leg down. And I've talked on this before, that this is my kind of line. And I think when we hit that after the initial rally there, that reaction low should do the trick and take us down through there. We've already hit all the targets down to T6, which opens a door that should we start to get down here, especially down below 18,500. That's again that peak low right there. It will probably be again, and I'm looking 5 steps ahead right now, guys. This isn't tomorrow, next week. It's probably not until after the elections. Who knows? We'll see if I'm right. That is, and there's a lot of ifs in there, guys. A lot of ifs. So manage your trade appropriate. But if we do get down there, I think we'll start waterfalling at that point between 18,500 down to, might even shoot right past T7 and hit T8. And I'm going to quantify it for you because, again, this is a live chart. So that's going to constitute a drop. It's tricky with this program. I have to click somewhere where I'm not going to move my lines and then kind of adjust the measuring tool line. So from the recent highs down to T8, that's going to be a drop of 21% roughly. All right, and T8 aligns with the, as you can see here, this is the 50%. This yellow line is the 50% Fibonacci retracement level. So I have T8 set right above that. T6, as I told you, I aligned these targets. That's why that was the ideal topping range even before we got there, because it made for, if we went up there, it aligned better. My price targets, which were based on support levels, would align better with Fibonacci's, and that's why I like to incorporate Fibonacci's into my trading. I always put my price targets first, then I throw up the fibs, and it never fails to amaze me how often, whether it's a long side bullish trade or a short trade, how often the key Fibonacci levels, 23.6, 38.2, 50, 61.8, how often they align with my price targets that I've already come up with. And this is kind of what we're looking at now. This is the, here, well, I can add a line, I guess, at this point. Let me find a place to draw it and make an adjustment later. See, there it is. I already moved one of those targets. Oh, that drives me crazy. Just can't stand that part of this, that feature where if you get even close and you try to activate a line, it's going to grab another one. All right, you can see that's what I'm trying to show you here, guys. We've broken up trend line on SPY, but we've yet to take it out on the NQ futures. And you can also see it aligns with that price support, that former T2 level. So I'm going to pause the video and fix that line I just moved. Yeah, I'll do that later. All right. So you have the futures, you have levels to watch, and now let's look at the 11 sectors in the S&P 500. Do it relatively quickly, wrap this video up, get it out to you. You know, from time to time I go in and I recheck the weightings. As I said earlier in the video, an index is simply a sum of its parts, and more accurately, a weighted sum. So in the case of the S&P 500, if you look at all 11 sectors, but you will want to give a much higher weighting. For example, technology is by far the largest. It makes up 1/3 of the performance of the S&P 500, and that compares to like 3% or less for REITs and basic materials. So although we can trade REITs, we can trade the ETFs there, it's not going to move the needle. The REITs could implode. Every REIT could go down half, lose 50% of its value overnight. But if tech has a good day, you're not even going to see the S&P register that. So this is why you want to really focus on these high-weighted ones if you are trading the indexes. So what I have here is a little minor uptrend line, but it's broken on XLK. And you can see I have price support about 227. If that goes, then, and I think it's an ideal target if this short trade plays out, probably come down here and hit this uptrend line right there, which we hit again. That's when we hit it on August 5th, right at the lows, covered that. It wasn't random. You also had price support there. You had a brief overshoot of the 200 days, which, as I said before we did, it's to be expected. Some indexes and sectors and stocks will overshoot a little bit while others reversed a little shy. And so collectively, and this is why I do these long-winded videos. This is why when I'm trading one thing, I watch 10 or 20 things. In the case of the S&P 500, I'll watch the market-leading stocks, the big fangs, or Mag 7, whatever you want to call them. I watch all these sectors. because if the S&P 500 breaks the 200-day moving average, I still may cover my shorts there instead of add to shorts, because everything else is hitting the 200s or support at the same time, and then you get these overshoots. So that's why you want to look at this collectively. Are the majority of sectors and the majority of key stocks at support on any given day as they were on August 5th? Hence the reason to cover, even though some have broken. Again, there's different support levels. Moving averages are one, but price support is, and trend line support is certainly another. So there it is, guys. I'll replicate that trend line, and whether I update it or not, let's just say hypothetically 3 weeks from now, or 3 months from now, your market's selling off pretty hard, and you're at this trend line, and you have other things that support. You might want to cover that SPY trade and game of bounce, or QQQ as well. XLK is going to mirror QQQ. This is all tech. QQQ is mostly tech. You can overlay the charts; they're going to look the same. All right, that's kind of an update there. You had a bearish engulfing candle at the top there. That was followed by a divergent high, followed by a 20% drop in the tech sector. If you missed that bearish engulfing candle, which I pointed out to you at the time, even though I was on vacation overseas, we had a break below, a secondary sell signal if you missed it on the break of the trend line. And so that was a 20% drop. And then we covered in reverse there. Another trend line break, another shorting up, and another trend line break, another shorting up, and another bearish engulfing candle. It's been quite a counter trend bounce. You can now have another bearish engulfing candle put in the other day. All right, that's tech. I won't spend as much time on every other sector, because tech's the biggest. Second largest, XLF financials as of that should be 12/19. Kind of did it the European way. Day first, and then the month I messed up. 12.5% weighting. So you can see the second largest sector in the S&P 500 is almost, what is it, less than half of the first largest, but it is still going to move the needle somewhat. As I talked about, we had divergence across the board there. There was earnings across, in general, were good, so the market bottomed, but they've been fading that. Nothing big yet. Nothing. I don't see any sell signals come until we break that trend line. But if we do, it's going to support the case that the S&P is going lower. So there's that uptrend line. Also comes off. It's not a random level. August 5th lows. When that breaks, you're going to have, I should give you a level. We've got a first targets right there. First support, 45.82, and then for 44.19. And then the financials never made it to their 200-day moving averages. So if you look, this is be a target if you want to short XLF. You have the 200 days coming in together, the simple and exponential just below. And you have this uptrend line I just drew right here. And you have price support about 42, 43, convergence of triple support there. That would be my target for the financials, at least a near-term swing target, calling them down 10%. All right, next up, XLV Healthcare. This one I did share as a short trade I did with you recently and via videos. We had a lot of evidence there, including the trend line break. Then we went on to break that level, bounced off this minor trend line, and took it out. Now we're testing the secondary, more significant trend line right here. Just starting to crack it today and headed lower. I even gave you an official trade with targets on XBI, which is a subsector of XLV. XLV is a healthcare sector, but that includes things from pharmaceutical companies to biotechs to medical device makers and everything else in between. But XBI is a direct play on biotechs. I highlighted this divergent high at resistance, followed by a trend line break there, that uptrend line there. We hit my S2 level. These are first and second support levels, bounce. So I still maintain a break of S2 is going to open the door to the deeper price targets that I gave you on that trade. Still like it because we're off that divergent high. We've had the sell signal on the break of the trend line, the impulsive rejection off the back test. Nothing to not like there, and I like it a lot better if S2 goes. All right, so that's kind of and that's going to bring XLV down with it. A lot of those biotechs, by the way, a lot of biotechs are in the Nasdaq 100, so it should also put pressure on QQQ if that happens, if and when. XLY, consumer discretionary, makes up about 10% of the S&P 500. Breakdown of that nice clean up trend line there. It's kind of zigzagging around. I'm going to pull this line. I'm going to I'm going to move it. Why did I do that? Well, it should represent, we had a reaction high here, and we've been dancing on it right there. So really, so the common theme here is another one. Pretty much a lot of things I have right now. I have the SPY breaking trend line support. That's why I put out as a short trade idea today. But I have other key sectors right now and stocks at support, be it either trend line support or in this case, price support right there. You probably could also do, and I will now, let's see if we had an uptrend line. I never had it drawn there before. Yeah, let's just leave it the way I have it. Keep this chart simple. So anything much below today's lows is going to give a breakdown there. Trigger sell signal, take us down to 188.27 and then 182 and change. All right, XLC communication sector, that's about 9.3% weighting in the S&P 500. Divergent high, this is the big level that needs to go. I think I already have an alert, so I'll set it there. That's a primary uptrend line off the January 2023 lows. Comes in here, here, and that a big divergent high, that's going to send us quite a bit lower in that sector. That has, by the way, communication sector, if you're wondering, has Meta, Alphabet, Verizon, T-Mobile, stocks like that in there. XLI Industrials, that just broke down here, this uptrend line. A minor support it's testing right now, 136.30. Next support about 134. And then that should bring us down and probably get into the 200-day moving averages at least. But a big divergent high says we could easily go down here, 120.41. That's purple because that's a very important support level. So if you want to trade this ETF, 120, that's about a 13% drop down there to the 120.41-ish level. This has companies like, which I just covered recently, GE, a lot of these defense stocks, aerospace, Caterpillar. You can see that, ooh, look at Cat. A lot of these guys are just perched, ready to break down. Uber, look at that on the uptrend line, ready. No sell signal yet, but that's why replicate these charts is what I recommend. Put price alerts. The more of these guys that break, the more likely this sector is going down. The more this sector goes down, the more likely the S&P is going down. Simple stuff, right? RTX, RTX Corp. There's the uptrend line. Benefit of the doubt support 123. Bearish engulfing candle yesterday, as I was covering. I think I covered it yesterday. A lot of these guys had just reported earnings, and bearish engulfing candle unless it's violated up on the top. That's a reversal sign. That's sell signal. One of my favorite patterns to trade because the RR is phenomenal. Basically, if it violates, if we move above that candle, then you no longer have a potential topping stick because it wasn't the top. Now, it doesn't mean you can't do that, but it just, the way you trade them is simple. Don't overthink it. Short it. Put a stop above that candle. Yesterday's bearish engulfing candle. It engulfed the last 4 or 5 candles there. And then remember, it's a topping stick. So if it plays out, it's not good for a 2-3% short-term swing trade. It's good for a trend reversal. And a trend reversal on Raytheon, well, let's go back. You can play around with the charts, measure them. You're talking double-digit gains that are on a trade that's going to last months, most likely. And the divergence and everything says it. So basically, it's a big bearish rising wedge. And again, I didn't want to digress too much, but I did mention this sector the other day is looking like a short trade. ITB, I think, is the ETF for the aerospace and defense stocks. Lockheed Martin, again, earnings just knocked the snot out of that. Beautiful uptrend line, bearish rising wedge, broke down, took out my first target already. Now it's opened the door to the second target. And again, I covered these the other day, but these are the other, I'm just clicking through again, the weighted components of the industrial sector. That's what I'm doing here, guys, to kind of give you a more visibility or more color on how the sector looks and their top components technically. So there it is. So UPS, that was a long trade recently, hit T1 and just can't get through. Seems to be stalling around. If you're still in this one, it's still a trade. It's still profitable. We hit the first target. There's an uptrend line you probably don't want to see violated, so you might consider a stop not too far below that. T2 was the final target, and it was a trend line. T1 was hit right here. We came close enough. Yeah, it's up to you. I would tighten up stops. We came close enough to, we didn't fully tag it, but yeah, that might be it for UPS. We'll see. We'll see if the market holds up. Then maybe we break out, and then I'll make these official targets, these potential ones. All right, let me get back to the rest of the sectors, and we'll wrap the video up. XLP, consumer staples. Somebody asked me about this a few weeks back, and I said, "Oh, beautiful ascending, broadening wedge pattern." There were a couple things that what I just drew. That's an ABW pattern. You have the requisite number of tags on the top and bottom, and then it broke down as expected. That's also a topping pattern. Gave you a sell signal, took us to my primary uptrend line. You also had, there was a lot in this chart, very nice chart, the bearish rising wedge, breakdown and back test. So there were multiple reasons. There was a sell signal there, and this will be the kind of lights out sell signal. There's your primary uptrend line off the October 2023 lows. Lots of nice clean reactions on this trend line, including recently. Breaks there, it's headed to 79.43. And this one has not checked the 200, so I'll call it down to the 200-day moving averages. That's going to be a total drop in that sector, at least of 7%, and quite possibly more. I don't want to get to go into the long-term charts, and but we'll see. But I'm just kind of focusing on the near-term stuff right now. XLE energy sector, kind of meh. I don't it's kind of up and down, divergent low recently. One of the better looking sectors in my opinion, but I don't have much of an opinion nor a position on that sector. XLU utilities, I threw it out initially as with an alternative, an aggressive entry before breakdown of this trend line, an alternative entry to come on it, and or break at that first support level 78. We still haven't broken S1. We went on to put a marginal new and still divergent high. That stop was suggested for the early entry, the previous entry. And then, if you took this entry or you take a break at S1, that'll have a higher stop. Or depends on where S1's broken. But again, this one's not going to move the needle because you can see here it's only 2.25% weighting in the S&P 500. So you can trade this, but, right now, my analysis for the S&P 500, yeah, it looks bearish. I still think it's going lower. I still think these targets will be hit, and that'll put a little bit, but a pretty small impact on the market. XLB is basic materials, only a 2.16% weighting in there. But just almost all these charts are just singing the same song. They've got this big negative divergence that's been building, and I know I've been talking about it since back here. And again, it's not as if it didn't play out. It played out for healthy corrections. This was a divergent high. This was another one, but it's the same divergence. It's just getting larger and larger and larger. When it does that, you go to the weekly charts and you can see, in the past what happened when we had such similar divergences. That was divergent high. That was the bear market back in 2007 to 2008, clearly telegraphed by negative divergence. There was another divergent high, double-digit drop, divergent high, double-digit drop, divergent low, just like we had a divergent low there at the end of the bear market. It's not all fully marked up. Don't always trade the basic material stocks. And that's it. We had a divergent high here, followed by that bear market or correction, whatever you want to call it. And we currently have this divergence. So again, that's just remember from time to time, remember to keep an eye on the weekly charts to kind of give you the, an idea what the bigger picture looks like. And then last but not least, XLRE, the REITs. We had a nice clean uptrend line here that was broken recently. Went down, hit the 50-day moving average, and will probably come down to this uptrend line here, plus the 200-day moving averages, which come in right with it. The exponential in red, simple in blue. So that's the most likely path for the REITs. Okay, and that's it. I'll wrap it up here, and I'll just say, look, there's not any guarantees on any trades, but it's the first time in a long time I've given you official trade on SPY. Obviously, my confidence is high enough to do that. I think we're going to go down. And I'm going to add this. I know, especially if you're new to this, nobody wants a short when the stock market is off, within, percent or so off all-time highs. But I shouldn't say that. That's not correct. I do. A lot of people don't. What happened is they'll start. Here's where people will start to want to short and start to. This is what usually happens. And no, at this point, I'm covering for a bounce. I'm going to game a bounce and go long. It's not objective anymore. So it was objective today when I got out to you. It's still objective now. it gets less objective as you get down and start hitting the price targets, especially the deeper price targets. At that point, the odds start to increase for a tradable reversal. And if that happens, and I get it, and you don't want to short, then I'll, as I always do, I'll point out my thoughts, whether it's when I'm going long, reversing. I'm also a very active trader. I don't always, in fact, I'm trying to get away from that because I know, during these fast moving markets like the last correction, I know it makes people's heads spin when I tell you I'm covering shorts and going long for a bounce on something I see on the 5 or 15-minute charts. And I get out to you, and then some complain, well, I didn't get the email till, and I'm already back into the other position. So I've done in recent years a better job of stating what's near term, short term, intermediate term, kind of the time frames, as I did today on this trade. I told you it's a trade that if it pans out, I think it'll be just a matter of a few weeks to a couple weeks to a few months at most, couple months probably, if it does play out to T4. And then again, the longer term targets based off the weekly chart, those are targets that are going to play out, if I'm correct, over the next year or so, to take us down to T7. And if we get to T7, I might add additional targets, and that's calling for a drop, the same drop I was calling for back before. I'm trying to just measure it for you. It's roughly a 40% drop in the S&P 500. But again, first things first. Let's see if we can top out here and start to get back below the market top range, especially get down under the 200 days. You really want to increase your odds for a long-term trade, something like this. You want to see the market solidly below the 200-day moving averages, not for a day, not for 2 days, but especially when you go on the weekly chart, which we have here. And if you're going to put them on your weekly chart, make sure you use a 40 period because that's the same as the 200-day moving average. There's 5 days in a week. So when you're on a weekly time frame, you need to set that as a 40 period moving average, and that'll show you your 200 days on there, right there. And so, they do a great job, as you can see, and I've covered many, many times, defining bull and bear trends. When you're above the 200-day moving averages, you're in a bull market. When you cross below, especially it's solidly below, you want to short rallies back to the 200s. And then when you regain the 200s, as you clearly did by this point, you want to buy pullbacks to the 200, as we did on August 5th. All right, that's it. And so that will increase the odds that we are in the next leg down of a new, or more powerful bear market. But we're still comfortably above there. I'm just looking right now for another potential swing back there. And if it goes the other way, because markets like what whoever gets elected in a couple weeks, then that's it. We move on to the next one. We focus on whatever it is at the time, be it commodities, precious metals, individual stocks, or any of the sectors that look bearish. All right, I got to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.